Hello again, everybody. We are on the receivable train, and we're to the point on the train where we got to talk about what do we do when people won't pay us back. And we got a couple of accounting methodologies that we're going to use. I mentioned in the last video, we don't go out and rough people up. We don't beat people up to get our money back. We have civilized accounting methodologies to take care of those uncollectible accounts. So the first we're going to learn about right now is called the direct write-off method. So I'm going to walk you through what is the direct write-off method and how do we use it. So I mentioned last time when we have a situation where we have uncollectible accounts, which is basically any kind of scenario where we have accounts receivable, we had an account called bad debt expense, and we kind of used that account to keep track of the expense of bad debt in the current period. What kind of debts aren't going to be paid? What kind of amounts are going to be uncollectible in the current period? And that's an operating expense. Again, the definition, operating expense incurred because of the failure to collect a receivable. And we got to record that. Under the direct write-off method, we don't recognize bad debt expense until the customer's account is determined to be worthless. In other words, we've determined that we are certain that that customer is not going to pay us back. Then we add the amount they owed to bad debt expense. So think about that for a second. What are some scenarios where maybe a customer wouldn't pay back their account? And I kind of mentioned them in our video before. And so maybe if you can think back to that video, or maybe just off the top of your head, you want to pause, take a second, try to think of a few scenarios where a customer might not pay back their account. If you had a chance to do that, let's go ahead and talk about a few of those. Maybe it's a scenario where the customer's gone bankrupt. Customers declared bankruptcy, all right? Maybe they're out of business, maybe they're bankrupt. You know they're not going to be paying at that point, so you can write them off. Maybe the debt has been outstanding for so long that now we're certain that they're not going to pay us back. Maybe they were supposed to pay us in 30 days, and now we're 2 years down the road, 3 years down the road, and we're just giving up. We're certain they're not going to pay. Maybe customers died. Maybe the person that owed money has passed away, and we don't think we're going to be able to collect it. So there are all kinds of reasons why we've become certain that we're not going to be paid back an amount that we're owed. Under the direct write-off method, once we become certain, we write off that account and include it in bad debt expense. So here's an example using a journal entry. On May 10th, a $4,200 account receivable from Mark Carson has been determined to be uncollectible. Now, we don't know what happened to poor Mark. All we know is that Mark is not going to pay. Bad Mark. So we got to, now that we're writing it off, record bad debt expense. Just like in solid footing, your expenses are always going to be debits when we originally make them. And we debit that bad debt expense $4,200. And then we credit the account receivable $4,200 because we're writing it off. We're literally taking that account receivable off the books because Mark's not going to pay. Doesn't mean he's a bad person. Just mean he's not going to pay. We're writing off that uncollectible account. So looking at that from a financial statement framework standpoint, like we've been doing in the new book here, we got an expense and we got an asset going down. Account receivable going down, that expense is hurting retained earnings. And then, of course, we're going to record that expense on the income statement, bad debt expense. So that is called the direct write-off method. What we love about the direct write-off method, boy, that's easy, right? We just wait until they prove they can't pay, or we know they're not going to pay, and then we write them off. We don't have to do anything until we're sure they're not going to pay. Super easy. The only problem, the bad news here is really we can't do the direct write-off method under GAAP accounting. And most all larger businesses are using GAAP accounting. Okay? And so really just small companies, small businesses are the only ones doing the direct write-off method. Companies that don't really have a lot of account receivable. We saw on the Amazon balance sheet where they had 24 billion in account receivable, you can bet your bottom dollar they are using the allowance method and not the direct write-off method. So it has its place, but not every company is going to be able to use a direct write-off method. One more thing. Sometimes they come back. What do I mean by that? Sometimes we write off an account and the customer comes back to life. Zombie customer. And now they've repaid us. Okay? It's rare, but sometimes we write off an account and that account ends up being collected. Sometimes they come back. So how do we handle that? We basically reverse out the write-off. An example, we wrote off Carson. He had a $4,200 account receivable with us. We wrote it off on May 10th. And lo and behold, November 21st rolls around and he is coming through. Mark is paying his debt. So literally from a journal entry standpoint, we reverse out what we'd done before. This entire entry is simply a reversal. You can't see the end of that because it's blue on black, but it does say reversal, trust me. Reversing it out. Then we simply collect it. We're collecting it right here, just like we would any other account receivable. So we reinstate it by reversing the entry we made before, and then we collect it. Easy as that. If we look at financial statement framework, we're adding that $4,200 back to receivables, and we're adding that $4,200 back into retained earnings because we're reversing out that expense. You're adding that expense back into the income statement. Kind of weird to think that we'd be adding an expense back into the income statement, but we reversed it out. So that's exactly what we're doing. When we collect that $4,200, we're adding that to the cash account. We're taking it off of the account receivable. And then we're recording it in the statement of cash flows as a positive $4,200 where we collect that money. So that is our direct write-off methodology for handling those pesky uncollectible accounts. The real deal that we do in GAAP is coming up next, the allowance method. I'm going to walk you through what we do under the allowance method, and then we'll try a few homework problems, and hopefully we can work them out okay. We'll see you back here for the next video. Until then, take care.